And we are live. What's up, everyone? Welcome to another episode of Ask Me Anything Happy Hour with the BYOB Money Multiplier Money Mentor team. We're here to answer all your questions around infinite banking, becoming your own bank, real estate investing, private money. We got it all on this show. We can talk hockey, we can talk football, we can talk Ironmans, we can talk railroads, we can talk Black Widow spiders. I heard Ralph is an expert at those. He's got a couple of those pets.
I burned them all.
Of course, Miss Tess is here, an expert in the insurance industry. Linus, I don't know. Linus got the beautiful beard, so you might want to ask him about that. But we got the whole team here to help out today. So put your questions over in the chat box. We'll get to those and rock and roll. Be back in about 14.13 seconds. All right. It's been a fun day today. Mr. Chris Noggle is traveling down to a mastermind boardroom in Cabo, actually, and then out to Washington State to meet a business partner, making things happen like always. So we've been holding down the fort, but had a good show with St. James this morning on what the F happened. Just so much going on with the government shutdown, the economy, debt continues to go through the roof. For the first time ever, the average vehicle in this country is over $50,000. Prices just keep going up, except for eggs. We found that eggs have had an 83% drop since March. So at least the cost of eggs is down. But with that being said, I understand a lot of people are struggling, a lot of people with debt right now. We're here to help. We've created something called the BYOB Vault to visually show you exactly how we can help you using the infinite banking concept. So get your questions in. The team's here to answer all those questions. We talked earlier on Wealth Webinar. Was anybody on Wealth Webinar earlier? Anybody join us for that? We were talking all about an upcoming event that we have November 7th and 8th with a VIP night November 6th. But that's in Orlando, Florida. So 2 weeks away. Looking forward. A bunch of people from the team are flying into Orlando. We're meeting in Orlando with about 100 of our clients. So we're going to be talking about real estate investing, private money lending, infinite banking for 3 days. Have a great time together. Really looking forward to seeing you, Joe. It's been a while. I just got to stay away from you and Kevin at night, but that's a whole nother conversation. But get your questions in. We're going to do around the horn and we'll get to answering those. So I'll shoot it over to Brian Fouts, a.k.a. the Black Widow Whisperer.
I burned them all, believe me. they met the demise. Now, Brian Fouts up in northern Idaho, and actually Craig says, yeah, I'm about maybe 30 miles from the Canadian border as the crow flies. There are no roads to it from where I'm at because it's all mountains. But yeah, I'm very far up north. But yeah, into our hunting season and all that kind of stuff. We already got some wild game in the freezer, so having fun up here and getting ready to have some fun in the wintertime. But yeah, I'll leave it over to Tess.
Hey, I'm Tess Hulek, and like Steven said, insurance has been my life since I was probably 18 or 19 years old. I started in the accounting department, and I may not be in, where are you, Brian, Idaho?
Yeah.
But I am 20 minutes from Canada. I just shoot through Detroit. So I'll hit it through Detroit, and our New Yorkers hit it through Buffalo. So I'm thinking that might be a requirement. You must be close to a Canadian border in order to be a mentor. There you go. Well, except for, say, Jason. we made an exception for Jason and Lennon.
Or Steven.
It's Steven. Okay, 50-50. Now let's go down to Linus.
Thanks, Tess. Linus Nolt here from Hopkinsville, Kentucky. Took off a week when we went out to the Money Multiplier Mastermind and also busy getting ready for colder temperatures. So I feel like I'm barely keeping up with some of the emails coming in for people that I can help with infinite banking to attack their debt or to go out and invest with more efficiency. But I love what I do. So it's at least not stressful trying to keep up. That's about all on my mind right now, except maybe my beard, like Jason noticed. Guy down here actually asked, what did he say? Andrew says, grooming tips or tricks for the beard last? No, man, that's actually my question. Does anybody have any tips or tricks for me? I'm new to growing a beard, or fairly new. I actually don't care for it the way it is right now. It wants to like curl different ways. I don't really care for that. So I'm thinking of going a lot shorter, or maybe have a professional deal with it. See if it can, if I can maybe get it to look better. So maybe it looks better through camera than what it does in person. The women in my life, my wife and my little 4 daughters, they do not want me to get rid of it. So I'm slow to get rid of it or go super short. But Jason.
Is he muted? I think
Yep,
you're
he's muted.
You're muted, Jay.
We want to hear you.
Not muted now?
There
No,
you
you're
go.
not.
You're good.
We hear
I've
you.
been talking this whole time.
We were
Okay.
missing your voice.
Linus, I'm glad the Note women have voted. I concur. Keep the beard. Keep the beard. Make a t-shirt. Keep the beard. Get it groomed. It's getting long. It's looking good. It reminded me of something a moment ago, but then I was muted and now my brain went somewhere else. So I already forget. So I'm down here, City Beautiful, Orlando, nowhere near Canada. And I won't be anywhere near Canada anytime in the foreseeable future because it's cold.
It is.
70 degrees this morning, and I put long sleeves on to go ride my bike. So if it gives you an idea of how soft you get if you live in the South for 20 plus years, like Linda said, and everyone else here, we're super passionate about what we do. Ask us a hard question today. You guys are bringing the same questions. We answer the same questions. It feels like the same show. Let's get difficult. Throw us hard questions. Throw us easy questions. Just bring us questions. Over to my buddy Joe Helock, who will laugh, and I'll leave it with laughter when I disappear.
Oh, here he goes playing hide and go seek on me. You know, he he knows I like that. Better known as Joe Helock here. I am approximately 12 minutes from the Peace Bridge, so I think I might be actually closer than the other two.
Yeah, you're doing.
Yep. I'm up here in Buffalo. It's starting to get a little bit colder. It's in the 50s. Still wearing shorts and short sleeve shirt. Well, then again, I shovel with shorts and my Crocs on. So, but that's besides the point. Here to answer anybody else's questions other than the weather and snow. So bring them going.
All right, everybody, get those questions into the chat box. We got some that have already come in, so I'll go ahead and get rolling on these ones. But as you come up with more questions, please go ahead and put those in there. So RJ has a question here. In a survivorship policy, if one spouse dies and the surviving spouse remarries, can the new spouse replace the dead spouse on the policy?
I do not believe so. I'm not sure, but I do not believe so. I mean, it's been a long time since we had to take the life, health, and annuities portion where I had to know about survivorship, but I don't believe so.
Yeah, you'd have to get a new policy from my recollection. Got a new policy. So
Yeah. Typically not. It's not the type of policy that we really work with because it really doesn't fit the infinite banking concept as a whole. But I was curious, so I did a search and got an AI reply. Yeah, typically not. Benefits are tied to the original spouse's name in the policy. However, if the surviving spouse may need to review the policy terms and possibly update the beneficiaries or coverage options after remarriage, if that was the case. Yeah.
Yep. There you go. Good question, though. Yeah, I've come across those before. So people are asking, "Oh, can we roll it over and do that kind of stuff?" Typically, no. Those are kind of locked in. Those kinds of policies from my research. You can't really do much with them.
Yeah, those policies tend to be traditional whole life, not specially designed the way that we do them.
Yeah, they are typically permanent insurance. Like, yeah. All right. Let's see here. All right. Deborah N says, if a person doesn't have enough money to start infinite banking, what would you suggest they do first?
I have two answers. Number one, look into velocity banking, see if you can free up some capital. You know, depending, you talk to Mr. Helock if your debt to income ratio is good, or the other easy answer is what Patty told me a little bit ago. Jason, just go make more money. Go make more money. Like, why do we have this charge? I don't know, but go make more money, right? So that's the other answer. Go solve someone else's problem so you add value and they pay you money for it.
I actually have a question for Deborah. who says that you don't have enough money to start it?
Yeah. I was gonna say is what's making you say that in the first place?
Yeah.
Yeah.
Do you pay yourself first?
It depends on what is the purpose why we're doing it, is to get out of debt. How much money do we have to leave in the policy opposed to how much we're running through? So by you asking that question, it seems as though you need to have a call or a little bit understanding of how these policies are built.
Yep. And one thing I would suggest, just kind of as a side comment here, is definitely understand where your money's coming from and where it's going, right? Because those are two things that you can somewhat control. You can control more where it's going, but if you can get a control onto where your money's coming from, obviously you can increase that income, and then you can also look at where it's going and obviously get a handle on making sure you're controlling where it's going, because a lot of people don't really think about where the money's going. It just magically gets spent. So it's kind of two things that I definitely have worked with people on one-on-one is where's it coming from? Where's it going? Make sure you control those things as much as possible.
Some reason a Cotton Eye Joe popped into my head, Brian. I don't know why.
Exactly.
Okay, so Craig, he said, how do we find wealth webinar? I looked but found nothing. Go to chrisnoggle.com. So chrisnoggle.com, and then go to the resource events and resources. You'll see it down there. It's a Zoom thing, so you'll actually register for the Zoom webinar, and that's where you'll find it, is at chrisnoggle.com.
And replays will be on the YouTube channel.
And
youtube.com/@the-Chris-Noggle.
And somebody just put the link tree in the chat, so you can get all of our weekly trainings from that link tree.
There we go. Love it.
And if you subscribe, then you get a little text message saying when we go live.
There
Yeah, you will never forget. You don't want to miss.
Yep. So Prophetess Empress Africa Sankafa. All right. Love the name. Can the private bank be put into a private trust rather than your own name? And how does that work?
Yes. Yes.
And
how does that work? And it would be the owner instead of your name. Instead of it being privately owned by your name, it would be owned by the trust. And then the beneficiary would be the trust also.
Depends on what you're trying to accomplish too, right? Some people start right away with having the trust own it, have the trust fund it, and then you have additional documents that'll go with it. Or if you want to own it personally and transfer the ownership later, you can do that. Sometimes that's easier. It just really depends on what is your ultimate goal and like what does that look like as far as what you want to work on up front.
Yeah.
There are pros and cons either way, depending on how you're going to use the trust. If the trust is the owner, now the trust must pay each year. It has to come out of that trust account. And if it was in your name, then it would come out of your bank account. So that kind of needs a strategy call to see if that would benefit you or not.
Yeah.
Yep, there you go. All right. So this question, we have never seen this one before. Veronica says, what do you recommend more for BYOB, whole life or IULs? First and foremost, just go to Chris's YouTube channel and just type in IUL, and you'll get some videos that talk about this at length.
Yeah.
So,
but
now,
let's tell her you cannot do infinite banking with an IUL.
Right.
There are agents out there that say you can, but if you're doing banking every day, using money to put into your gas tank, using money to go grocery shopping, and you don't have access to your money for some years, how can you use that money today?
Right.
That's kind of the question that I throw at you.
And there's lots of actually technical reasons too as to why we don't use IULs. One, the projections do not equal reality on the illustrations. Mm-hmm. They do not perform as illustrated. So we've seen that. Cap rates and participating rates reduce returns, so you can actually have less returns than what they projected. I've talked to so many IUL people that have IULs, and the performance of the IUL frequently, if not almost always, underwhelms the expectations they had around what they thought it was going to perform at. And so pretty much they're always disappointed in their IULs. There's hidden fees. There's something they call structural drag, which is the hidden fees behind the scenes. You have rising costs of insurance. So that means that potentially you could lose the entire thing down the road because you reduced premiums and didn't put enough in. I mean, the list goes on and on and on, by the way. That's just off the top of my head. There's probably a lot more reasons.
I have one. Why would you want a zero floor and make nothing on a vehicle when these are guaranteed to always increase?
Yeah.
Yep.
And Joe, to a point earlier, just to be contrarian for a second, so we're all not saying the same thing. You can technically use an IUL for banking. I mean, I know there's people that teach it the right way. There is cases where it might be successful, but more often than not, you will fail. There will be things out of your control, and you are taking on all the risk. You're once again, Veronica, assuming all the risk. So can you do it? Yes. Do we recommend it? No. If you're a certified infinite banking practitioner, like most of us are, all of us are, you aren't able to even consider that as an option. And why is that? Because we're here to help you, not to make more money than you possibly could by selling you something.
You know, and I almost think like it's automatic that we know that all of us are practicing IBC. I would ask the person who's trying to sell that to you, how long have they had a policy in IBC and how's it worked for them?
Yeah. If it's an IUL, how long have you been using your IUL policy for banking? Right.
Yeah.
And how has it worked? Give me examples. Because I've talked to people that use it, and I've talked to people who have several policies and they've done their real estate through it and they pay it back and they kind of understand it a lot more than most people that are out there selling it.
Right.
Yep.
Here might be the closer for this. So Chris Noggle, in conjunction with Chris Kirkpatrick from the Life 180 channel, have had a challenge out there. I think it's a $10,000 challenge to any IUL agent that can show a policy that's been enforced for, say, about 10 years or more. I think was the
10 years.
10
the
years.
criteria. Yeah. And it needs to match or exceed the original illustration.
Yes.
Nobody has come forward yet, to my understanding.
Not one person.
Yeah. What does that tell you?
And I think
I've even read a statistic that says that IULs perform 70 to 90% lower than expectations on average. That's a staggering difference, by the way. And then the last thing I'll mention is, and I told someone to do this live one time, I said, go to ChatGPT or one of the AI softwares and just type in, are there lawsuits with IULs? And you'll get a really fun response, by the way. Not fun if you have an IUL. So, but yes, there are lawsuits around IULs because of what I just said and how they're being marketed. So just keep that in mind.
Do banks use IULs or do banks use whole life? How about that one?
Yeah. Whole life all the way.
Yep. They wouldn't even think of using an IUL for it.
Good point. Banks have bought $225 billion worth of whole life insurance, and I don't think they're buying any IULs.
No.
Here's another thing to ask your Google or your AI. Is my IUL's death benefit guaranteed for my whole life? And the problem is it's not. They'll guarantee it to a point, maybe age 80, maybe age 90, or even 100 if you're going really, really solid and paying large premiums in relative to the death benefit. But for the most part, you have a high likelihood of actually outliving the policy. It's going to lapse before you do.
Oh, and by the way, I have a VUL, by the way, and guess what? Death benefit goes to zero, and you lose all the cash value eventually. Mm-hmm. So
this is wild.
We all have personal experience with these kind of things too. All right, let's move on here. So
I was hoping the same thing.
We could dissect this horse for a long time. All right. So Deborah Ann, so she's the one that asked, how much do you need, or what if I don't have enough to get started? Well, if you haven't worked in 19 years, then yeah, you probably can't do infinite banking because you do need to have income and cash flow or high liquid net worth to do infinite banking because you do have to qualify.
Brian, could you go through each of, she's put a bunch of stuff in the post that kind of continues the story. So maybe we can go, here we go. Yeah. Right. Thank you for your service, by the way, Deborah. That's awesome. We work with a lot of veterans, so we really, really appreciate everything that is given to us through your generosity, right? Through your service.
Yeah. So you do have income. So even though you haven't worked, so income is income is income. Doesn't matter if you work or not, by the way. So if you have, you have to have a certain amount. So 10 times your age is the minimum, and roughly 20 to 25% of your income on an annual basis. So that's kind of the math there. So you have to at least meet that minimum income threshold to be able to do infinite banking. So once again, 10 times your age per month times 12 for annual. That's like the minimum premium. And to see if you have enough income to qualify, 20 to 25% of your gross income before taxes, that's the annual number. So obviously your annual number has to be above your minimum 10 times your age per month times 12.
Or if you're over 60, do 15 times your age, because why? Because you're in the third or the fourth quarter, right? Depending on how far over 60 you are. So you need to have enough going in. And Joe, I can see your face saying, well, that's not really a good answer. Like, it has to be, it depends on what we're solving. If you're talking to us on a call, we're going to say, hey, you can go up to 20 to 25% of your earned gross income on an annual basis. And we usually suggest following the first law of wealth of putting at least 10% of what you're making into a policy. Because if you're going to store the money you're paying yourself, where's a better place to store it than whole life? How's that, Joe? Does that make you happier?
You were getting there. These policies, Deborah, are built with two things. We have base and we have PUA. PUA is the banking portion. So when I talk to clients, I ask them, how much money can we leave in the policy per month for the first 12 months that wouldn't affect your food, your income, your livelihood? Is it $100? Is it $200? Is it $300 a month? And then that's where I would build the PUA on top of that. So if you could leave in $200 a month, that would be $700-800 a month that we could run through the policy, and you would still be able to use that $500 to pay your credit cards, that $500 to pay your car payment, and you would be paying yourself first before paying that bill.
Make sense? Yep.
Yeah, I love that explanation. She has another comment down there mentioning something about having gotten a traumatic brain injury and many illness. Sorry to hear that. It's a lot to be going through. She says, feeling better, but still working with Department of Rehabilitation to see if she can work by doing a stress test. Hearing some of those things, I'm guessing you may not qualify for a policy on yourself. Might need to look at getting a policy on somebody else, a family member, maybe a healthier spouse, or better condition, I should say. So that's certainly something that you should get on a call with us, and we can see if we can help you.
If you have another insurable interest, I helped another veteran recently who multiple time cancer survivor. No way we could get her approved, but we're able to get one on her spouse. And that has actually just gone in force this week. So it is possible. You just have to have other insurable interests. So,
yep. Cool. All right. Main Blue says, I have my LLC set up and then a solo 401k. Is there a way for me to fund a deal? I'm assuming you mean a policy. Fund a deal through my solo 401k, or would I have to set up an additional LLC with my solo 401k money? So the LLCs don't really come into play when it comes to the policy, to be honest. The only way you can really fund this with the solo 401k, because it's a self-directed 401k, is one, permanently withdraw the money, pay the penalty and income tax, or you can do a loan against the solo 401k, depending on who the custodian is and the rules around that one. You can borrow against the 401k, which is a 401k loan. You got to pay that back, and that could then fund the policy, if that's what you mean by deal. But you really don't need it to have an LLC really set up to run the money through to an infinite banking policy. It's my opinion.
I think she's talking about a PMC deal.
Mm-hmm.
There's another one down there, PMC math, if my cost to borrow over 5 years.
Oh, there we go. Yeah.
Yeah.
So in that scenario, I mean, it depends on, why would you do an additional LLC then?
Right.
No, you wouldn't have to. You can do the deal right out of the solo 401k if it's a self-directed IRA. You wouldn't touch the deal, therefore there wouldn't be any penalty. It would go from the custodian to the deal, and then the deal would take the interest and put it right back into your 401.
Yeah. The only thing, if you're trying to run it through an LLC to get, to have more like the deduction and things like that, you might be able to, you have to talk to an attorney, by the way, to do this. You want to talk to an attorney to see if there's some paperwork you can put in place to do that.
You're going to break the rule by going into an LLC. If it's qualified money, it needs to stay qualified. It can't go back and forth over the water. So the solo has to go to the deal back to the solo. If you wanted to take your private money, lend that to the LLC, and then add that money to that deal, that's fine. But you can't go back and forth with qualified and non-qualified money.
Right.
Yeah. Here's the rest of it right here. So the math, if my cost to borrow over 5 years is $900 per month, I'm trying to figure out what types of loan terms would make sense. You guys have any examples, etc.? Do people pay interest only, that kind of stuff?
I'm wondering why she has a cost to borrow. Well, I'm assuming why she has a cost to borrow for $900 a month. If you're lending straight out of your 401k, you wouldn't have a cost to borrow, would you? Unless
you would. Well, no, it depends. Yeah, no, if you're not borrowing from the 401k, if you're doing a 401k qualified investment, then yeah, you're right. So why is there a cost to borrow?
Yeah.
She may be referring to a 401k loan. You may be right there. But if it's a solo
qualified investment, you don't need to.
Right.
If it's a solo 401k, she would have the power, the control in order to actually make that PMC deal a qualified investment in the 401k, wouldn't she?
Direct investment. Yeah. There's no cost here.
I'm totally confused. That's over $45,000 in interest. Her cost to borrow is borrowing over $900 a month. That's almost $8,000 a year.
If it's a 401k loan, then that would be principal and interest. So keep that up. It could be that. But yeah, once again, and Maiden, we would need some more information on kind of what you got going on here. Definitely she's talking about a deal on Private Money Club.
I guess
right here. So I thought you had to take a loan, so you don't. You can, if it's a qualified one, you can go direct. So that way you don't have any interest on the 401k monies. So there you go.
Do you know if, for that solo 401k, is her and her LLC the custodian of that 401k, that solo 401k?
Well, the custodian is going to be like, Fidelity or whomever is the company that you have it with.
But it's essentially self-directed.
It depends on where the solo 401k is.
Yeah. Okay.
Yeah. So I've had those before, and I've lent from solo 401k. So I've done that before. Yeah. There's fees, of course, to do it because there's transactional fees, but that's pretty much it. There's no other cost. So.
That language might get a little confusing. Lent from it. So what Brian just said is that he did not borrow from that solo 401k. He lent out. So the solo 401k was essentially the lender to a real estate borrower, whatever the case may be.
Just how I said it before, from the solo 401k to the investment goes back. Yeah, you're with Horizon. Absolutely. Yeah. So you would talk to Brandy and set up a direct to invest and work with whoever you're lending it to, and it would go directly back and forth between the 401 and the investment.
And if the 401, if that is in your name, your LLC couldn't own it.
Correct. Yeah, you can't with a 401k or solo or a self-directed IRA. You can't touch the funds. Essentially, they cannot go through your hands. They got to go direct, and you cannot handle them because of the tax issue. So, what I did though is I had an LLC that was associated with the whole transaction. It just couldn't have ownership of it, but I could do deductions through it. So, so I had all of my expenses, educational stuff was inside the LLC.
I want to know, why do you want the LLC to own it? That would be my first question. I don't see that.
I got a comment here. It says if she takes a 401k loan, lends through PMC, the arbitrage on interest could leave the 401k, wouldn't it?
If she takes a 401k,
it all has to go back to the 401k. If you're going direct, if it's a 401k loan, then it's just cash.
Yeah.
But then you've got interest tied to the 401k. So, I mean, to be honest, the 401k loan is not always a bad thing because you're paying interest back to your own 401k. So you're actually building your 401k, but you can't take the interest from the investment and put it back into the 401k, generally speaking. So
she's talking
I've done it both ways, by the way. I've done it both ways.
And she's talking about the interest leaving the 401k. And you wouldn't want to do that because then it becomes taxable.
Mm-hmm. Yeah, there's a few ways to do it, but Horizon Trust, by the way, just call them up. They can give you the options and walk through this for you. We're sitting here just kind of armchairing this. They're the experts, so I just recommend talking.
Yeah, that's something I was going to say. After all this, here's the disclaimer: we're not tax professionals. Consult with your own CPA and attorneys if needed. I saw something from Rob J down there where he's saying her solo 401k might own the LLC. In that case, it's super simple, and she can transact directly through the LLC. And potentially, maybe right there, maybe.
And Horizon would know that because they set it up for her.
Yeah.
I've been lending back and forth with my self-directed 401k with Horizon since 2018, and that money goes directly from Horizon to the investment right back to Horizon. I never touch it.
Me too.
Yeah, that's how I do it.
Yeah, me too.
That's not fun right there.
Oh, Deborah.
Yeah, that's no bueno there. Sorry about that. That's not good. All right, so we got a few questions coming up here. Let's make sure we start getting through some of these. All right, Sarah says here, would using the vault tell me what my DTI, debt to income, needs to be to get a HELOC, or should I get it to a certain percentage before I buy into the vault? I guess I'm not sure where to start, but I know my debts are high. So the vault's not going to tell you your DTI, because there's a lot of specifics in that. But obviously, we can help with that. Actually, one thing you can do is go to dinkytown.net. So Google it, dinkytown.net, and they have tons and tons and tons of financial calculators. They have DTI calculators on there, and so that's the one that I always use.
Or you can call me and I can pre-qualify you like I've done with hundreds of other clients.
Yeah.
Do you have a simple formula that Sarah could use, Joe, to kind of understand what that debt to income needs to be so people can just kind of hear what a simple, other than going looking for calculators or getting on a call with you, is there a simple way that they could figure it out?
It has nothing to do with what you owe. The DTI goes out of the 80 to 85 to 89% of the actual HELOC loan value. So it has nothing to do with the debt. Now the debt is going to be living inside the HELOC. So what is the credit score? What is your income? Are we going to go at 80? Or are we going to go at 89? So that needs a conversation. So once you figure out that number, now you have to divide by the interest rate of what the loan is going to be at, with a 45% on your income to achieve that number. So you have a 45% debt to income ratio on your available income that you can put towards your house, minus your taxes, minus your interest on the total dwelling, and then go on the other side and figure out what number between 80 to 89 that you're going to calculate on the interest, and then run all the debts through that, and then compare both numbers. There you go. That's how you do it. Just call me.
Clicking and popping. Just call them, Sarah.
This is what happens when you do something almost every day for 15 years.
All right, so JC has a good question here. How unhealthy is uninsurable? Aortic valve replaced on 9/2019. All good since. Type 2 diabetic. We're an insulin pod. Decent A1C, ex-smoker, not athlete, but not couch potato. My opinion here is you're probably going to be uninsurable. The main reason why is the type 2 diabetes with insulin pod. So if you're type 2 with no insulin, you're fine. Type 2 with insulin, it's almost typically, from my experience, is a no-go.
With an A1C less than 7.
I haven't had anybody get approved. I don't know if anyone else has, but with a valve replacement, I haven't had anyone get approved either.
That's the second thing I was going to say, is that combined with that one, even though it's been 6 years, typically 5 years, kind of a threshold there. But even with that, I haven't seen anybody yet get approved. So JC, that's why we always say that if you have somebody else in your life that is insurable, that you have insurable interest on, spouse, adult kids, that kind of stuff, business partner, there are options in that regard to do infinite banking, but that would just be a call into one of us.
Yeah.
And for everyone listening, I mean, thank you for being vulnerable and sharing, your exact situation so we can talk about it. And I think it just kind of emphasizes the point of how valuable it is to be able to get approved for something. Like when you're not able to have something that you really want, you want it more, right? That's just our human nature. And now you're saying like, hey, it's not always easy to become a partner with one of these mutually owned companies. So you go through the process, find out who can be another insurable interest for you. There's ways around it, but the best way is to start when you're able to get approved.
Yeah.
And age is going to be a factor based on the things you mentioned here. There's a slight possibility depending on more details, and it warrants a conversation, and we could look into it a little closer. But like you were saying, yeah, probably going to have to end up looking at other insurable interests around you.
Yeah.
Yep, there we go. All right, so Craig's asking, so Mr. HELOC, my girlfriend has a $600K equity in her $750K home, but she couldn't get more than a $40K in a HELOC due to her DTI. Her home is basically all her debt, and she makes about $50K per year. Can you help?
Possibly.
I thought when I first read that, they said Mr. HELOC, my girlfriend. I thought Mr. HELOC was the girlfriend. So I got a little confused. There for a second. Anybody else? I'm telling you, I'm not even joking. That happened in my brain.
1875.
While Joe's clicking and popping, we'll just fill in the dead air space. So we're not just watching him use a calculator.
Equity.
Jason's brain does entertain us from time to time.
Time to time. It's hit or miss.
All right. So when we look at this that you just threw at me, she only owes $150,000 on the house, which is fine. Now the $50,000 needs to have the 45% DTI, which is $1,875 a month. Out of that $1,875 a month, we have to minus the taxes and the insurance from that number. Now we have that number, and now we have to see how much we can qualify for at the 7-8% that the HELOC is going to cost us. And then that number will be $150,000, $200,000. It will not ever get you up to $600 because it relies on the income and how much you can afford. So if we could utilize the income, go up to 45 minus the taxes and insurance, still come up with a viable number to get a substantial 150, 200, 250 number, and all of the debt would be able to be included in that. So say a $200,000 HELOC, and then we would swallow the 150. As long as she didn't have $50,000 in credit cards or a car loan, then yes, we probably could make it work.
He dropped in there, the 150 includes the current HELOC.
We would pay that off.
There you go.
Well, here's another thing too. If there's a second lien, now we can utilize velocity banking, a one-pot system. You might not just be using your the money in the correct way. So, we have to utilize and create a system, and that would be my one-pot system of what I use. So
Definitely worth a call.
Worth a call.
Yeah.
Yep, for sure.
Where'd Snaggy go?
He had to leave.
Yeah.
No, I know.
He checked out. He doesn't love us anymore.
I remember him blinking off a while ago. We've taken like 2 questions for the last 15 minutes. So
yeah,
we're running with them.
All right. So Nekamar says, do you do policies with Guardian or New York Life? Quick answer is no. We can do them with Guardian, but we don't because they're a direct recognition company, meaning that you borrow from the policy, your dividends are impacted and go down. New York Life, we don't work with them because in our experience, they don't really support infinite banking all that much.
They're
and we have companies that work with them. So,
and they're also direct as well.
Yeah.
Yep. For Chris worked for 20 years.
Yeah.
And he didn't even know about IVC.
Yeah.
Yep. See here, Jonathan Goins is I have no debt except for HELOC and policy loans. I currently put in about $7,500 per month into the HELOC and $2,500 per month into policy loan repayment. Both are being paid with extra money. More to come. Both are being paid with extra money on top of my regular monthly bills. Would it be beneficial to get another policy and run money through the policy to pay back or pay down the HELOC?
First of all, there shouldn't be any money in cash value of your policy because that is the asset in this situation. If I go back and say the house is the liability, we get a HELOC, we turn the house into an asset. Now we're running it through the policy. The policy is an asset. If we're borrowing it at 7, receiving 5.5 or 6 in dividends, it's only 1.5% of in the policy. You still have the liability of the HELOC costing you 7 to 8%. So in that actuality, you're not being efficient. You're not utilizing your money correctly, and you're losing 6% on your money by not paying the HELOC first. So that kind of would be a call.
Yeah.
And there, I mean, and John, I mean, some of everything Joe said is applicable, but it's also going to be based, like if you're saying, hey, can I open another policy? It's going to depend as well on what is your income. Like you might have to open another policy on another insurable interest, whether it's one of your many children or your wife or somebody else, right? So, and if it's your many children, then you got to insure them all equally across the board. So maybe the next move's your wife, if that makes sense from a numbers perspective, but it might not be on you.
And it also depends on, are we investing with that money? Do we still have, well, didn't he say that was all he had was the HELOC? I missed the first one.
That's
Yeah. I think he's working. I think he's already working with your team, Joe. So
okay.
Yeah.
He's been around. John's been around for a while. So
yeah. Marcia says, when would I start another whole life policy? I mean, bottom line is when you want to put more through it, but you can't because you've maxed out your current policy. I mean, that's the simplest answer right there. Hey, I'm putting in $500 per month through this current one, but I want to put 1,000. I can't do 1,000 on the existing one because you can't increase the premium, or you've maxed it out as much as possible. So you do a second policy and put more through it. That's the simplest answer right there. There can be other reasons why you have a lump sum of capital that came in. You want to put it through a policy. You want to do a dump in on another one. I mean, there's lots of reasons why.
You realize that you're way more insured than your spouse. You realize that you want to set something up for kids and grandkids. There's a lot of reasons to start these. So,
yes.
Knowing I don't think this is an easy answer. I remember 3-4 years ago, Joe, we would talk about this question a lot. Like, when is it? And we'd say, oh, the simple answer is when you got a 12-ounce mug with a pug on it and you can't fit 14 ounces of water in it, can you? And we found out since that sometimes you can, depending on the carrier. And sometimes there's other questions to ask. And there's always going to be, it depends. But to everyone's point, every question we answer is, what is your main outcome? Like, the clearer you are on the outcome, the better we are at assisting you. And if we're not clear, we're going to keep asking you questions till we get there.
Yeah.
And Marcia, I want to say it's kind of a gut feeling too. If you think it's time to get another policy, it might be, but then we would just need to make sure, with a call.
Or you might be hungry.
Marcia, we had worked together for your latest policy last year, I think it was, and I think you asked about this same question a month or so ago. I can't remember if I told you, but you would want to go check with One America on your current policies if you can add any extra PUA premiums without creating a MEC, and see if maybe they can hold more than what you've been putting in regularly so far. That's the one place to start. But yeah, what the other guys are saying here is right on.
And I'll text you the question you can ask right now. I have your information up.
All right. Let's
get to Sabrina or Mr. Hollingsworth's question. I know that's one I've been looking to answer.
Yeah, 1 sec. Yeah, I have that one next here.
Okay, just making sure.
Yeah, so we got quite a few questions to get through. I heard about lowering the PUA. You have to leave a certain amount per year in of PUAs so you can add it back later. It's $120 per year, $10 per month is the minimum PUAs in order to maintain the rider. So minimum $10 per month, $120 per year. And yes, you can catch back up the PUAs in the later years, but you got to do it. You can't wait 5 years though, by the way. So it will go down after that, but yeah, you can. So that's a good question.
And Dexter, by lowering the PUA, that is actually the banking portion of the policy. The PUA is what you're getting dividends on. So if you lower that PUA, Now, if you're borrowing it at 7 and you're not contributing to that PUA,
this comes back to a question we had a couple of weeks ago, Joe. We're going to go into this on a training at some point, I believe, but the base also drives a lot of the dividend.
Depending on what year it is.
It's not just a PUA, but the PUA is what's driving the cash value more, because that's always buying you more death benefit, giving you higher cash access, and it's increasing the likelihood of dividends. But the base is also, like, if he's going down, it's because there's something going on where he's got to go down to the manageable floor. You know, maybe there's a change, you're going on sabbatical, you can't work for a while, you got other needs for the cash flow, so you're going down to that. But your point is, a lot of what we're teaching in the banking is from the PUA, but the base is really important too.
Are you getting that in years 1 and 2?
Yeah.
There's dividends on the base in the first couple of years too?
I believe so. Yes.
Yeah. All right. It's good to get through these questions here. So Shane says, good to see you. You feeling better, Brian? Thanks, man. Yeah, Shane was at the event here a week and a half ago that I was at today. Well, didn't attend. I was in the ER for most of it. So my wife Sabrina asked the team how we could get policies on our kids with being self-employed. We do earn income. Yeah, I mean, it's easy to get actually policies on the kids because you're already insured and you have income. So it's very, very simple on the kids. I mean, you can get approved within a matter of days in most cases if they're kids, they're all young. So yeah, juvenile policies are very, very simple and very quick because you guys already have coverage, got the income, good to go.
Now that's a question. What is the age where it stops being considered a juvenile policy?
Well, when they become an adult, age 18.
18.
It kind of depends there too. It depends.
Yeah.
Like it's not so much being an adult age-wise. It's when do you go from being a dependent to an independent?
Yeah.
And sometimes, like, I've had cases of 18-year-olds, 19-year-olds, 20-year-olds that are still dependents, but then based on the parents' insurability and things, maybe the kid had a job that allowed them to have more going into the policy than going up to half of what the parents were insured for, up to $1 million. So Tess, it kind of depends on what you're trying to get approved for, what the goal is, what one you're going to use. Does that make sense to everybody?
If the child's still living at home and 22 years old and still going to college, that would be a dependent.
Yeah, I've done it before. It's you have to really explain the situation, and it's not always received very well. But it just depends. The one why I had it was very easy was when the parents were getting a policy on the kid, and the parents were, they were the guarantors for the student loans.
Oh, yeah.
It was so easy to get that policy approved.
Well, it's because you're showing something from an estate planning purpose. So when everyone's listening to these on a weekly basis, you know, the deeper you go into it, it's really about family planning. It's about estate planning. It's about looking at the overall purpose for the whole life, because the insurance companies aren't necessarily looking at this. Oh, we're building up this opportunity fund. We're building up this warehouse of wealth. They're looking at it from, what is the risk to us, the insurer, right? Tess, like, what is the amount of risk we're taking on? Like, how good of a partner are you going to be? And then, does this make sense? Does this make sense that you want to own a policy on your 19-year-old who doesn't live at home, but you're still supporting them? Like, maybe you're loaning them money for something in their life, and that gives them a reason why, you know, you have to be able to show the reason, like, tell the story. So, and for Shane, I know you already know this, and Sabrina, just so you hear it as well, like Brian said, you can be insured for easily, right? But it's going to be up to half of what you carry on your body, or Shane's body, whichever one has more, or depending on the company as well, up to $1 million. And if you want to have more than that, then we have to show reasons again from the estate planning perspective on why the kid would need to have more than $1 million. And they have to be insured equally, Shane. So even though you got your favorite kid, you can't just insure one more than the others. So.
No favorites there. They're all amazing.
All right. So last minute questions. We'll get through these ones here. There's a quick one here. So Rhonda said here, had a client who wanted to switch to whole life, had an IUL, supposed to be used for IBC, but guess what? Surrender fees probably made it unusable for infinite banking in the earlier. didn't want to touch it, just started a separate policy. I mean, that's whatever the best decision for you at that point in time. That was probably it. But yeah, that's an example of why we don't do IULs right there.
Yep.
Yeah. Had that quick comment on that. Had that conversation earlier today with someone who's had an IUL. Is a buddy of his, like, oh, you can just do $100 a month. So he's been doing that. He's like 4,000 in cash value, but his surrender value would eat all of that up, right? 4 years into it. And so I told him, I'm like, look, you can some people will keep contributing to get past when the surrender value goes away, which is typically year 10, or you can pay the dummy tax and get off now. Like, it's not a nice way to say it, but you made a mistake. Do you want to continue the mistake for another 6 years, or do you rather get off and maybe put it somewhere where you control it?
Yeah. Okay. Dexter says term insurance can fall off the whole life after it becomes efficient. If you leave it on, is it a benefit, like giving you more death benefit on top of what you already have? Yes, but keep in mind that the term policy is only there for a certain period of time. If you want to keep it going, that's renewable term, and it becomes more expensive every year and becomes eventually cost prohibitive. So yeah, you can, but you've got to kind of choose that term at the beginning of the whole life policy. 7, 10, 15, 20, 30 years. Typically 20 years is kind of the max use on these ones. But yeah, it's only a death benefit. That's really it after that first 7 years. And
you're limited, Dex. You're limited on when you can convert it, right? Like you have to convert that term or that convertible term by a certain age. So like recently I've started people who won't hit the ability to convert the term ever. So you just have to tell them up front, look, this is solely for banking, solely to increase your efficiency, solely to increase the number that you hit the efficiency point, or to Joe's verbiage, right? The cash tree. And that's why you might put a dump in when you're not able to convert the term. But Dex, you're a young dude. So if you want to have your whole human life value locked in when you're currently healthy, that might be a reason to have a large term policy as well. So
money tree.
Joe, if you want to, I don't know if you want to put it something in for.
It's on the bottom of my picture. If you want to open.
Your picture's not showing right now. There it is.
Real Money Masters /RMM.
Yep. Or joseph@chrisnuggle.com.
I think you should make that link longer.
Yeah. All right. Nick Lamar is asking, can I use a HELOC to purchase a whole life policy? Yes, you can. Schedule a call, because we don't have time to get into that right now. But the answer is yes, you can, but it has to make sense and the math has to work for you.
True.
Let's just keep that simple right there. Jay says, does the policy increase in death benefit when paying into the PUAs? Because Jay, you and I have talked. Yep. And he says he has a policy where the death benefit remains the same no matter how much or little PUAs go in. So yes, it does in the way that but it has to be specially designed to do that. There are kinds of insurance out there where you can have it, but it does not increase the death benefit. It depends on how it's built, and different companies, they'll have a flat death benefit for 10 years, and then it might go up from there. That's called combo rider and things like that. But it just depends on the company and how it's built. The way that we build them, generally speaking, every single month or year, it's going to go up. So
he's still increasing the permanent death benefit by paying into the PUA of the sort of design he's got. Mm-hmm. So basically, he's replacing some of the term death benefit with permanent death benefit by paying into the PUA. So it's definitely still great. It's just, it works a little bit differently.
Yeah. Laura says, at 58, how much would infinite banking cost me? One, don't view it as a cost, right? So view it as a system that you want to fund so that you can become your own bank. It's not really a cost, but the minimum is 10 times your age per month. The maximum, because there's a range of what you can do, and you want to do the what's going to benefit you the most and going to help you accomplish your goals the quickest. That upper limit can be a different number. So $580 per month, up to a certain number that we'd have to let you know what that is on a call. But the number really is not the minimum. The number is the one that is going to be the best for what you're trying to accomplish. So
up to 25% of what you earn with, following the first law of wealth of paying yourself at least 10%. So,
yeah. And then Bede has a question here. All of you look like you're broke. Explain why we should listen to you on creating wealth. I'm going to give you a very honest answer. Yeah. You should not listen to us. You should go somewhere else.
Yeah,
that's it right there. Go somewhere else. If that's how you're going to approach us and how you're going to be respectful, go somewhere else. I mean, there's a lot of nice comments back to her on that one too. Yeah, so Shane's got some good comments here. So you guys, so Shane's been around the campfire for a long time, so he's actually responding to a lot of the questions here, and he's got a lot of experience in doing this stuff. So definitely look at what he says, because it's the process. He's been around, he's been using it, and it took him some time to figure this out as well. So there you go.
Yeah, and I've said this before, but if you're new here, Shane came in as someone who was it was something that just seemed too good to be true. He's a super numbers spreadsheet driven guy, and so wanted to see everything. And some of I'm not a spreadsheet guy, so I was like, Shane, you got to do it. You just have to do it and get in there. And now he is contributing on every show we do. He is the one that is successful. He has gone from having a W-2 income to having passive income. Now he has his wife on board, and she's loving this. I mean, the amount of growth over a short period of time, we're talking less than 4 years, has been astounding. And if you get to meet Shane, he will tell you the same thing. Now, with what he's doing, getting the kids involved in other things, it's amazing. So that's one reason why you might want to listen to us. Even though we look like a bunch of broke-ass brother-in-laws, but we know what we're doing. Individually, I've had more than 3,500 calls, whether I'm talking to someone worth tens of millions of dollars or someone that is paycheck to paycheck at best, right? So. Yeah.
We're here.
All right, everybody. That's another Ask Me Anything in the books. Appreciate all the questions.
Did it?
Yep, that's it. We did it. So we're 2 minutes over. So, oh my gosh, we're late.
Patty's sending me little memes and she would call him Bob Sponge instead of SpongeBob, saying, hurry up, hurry, and Beavis and Butthead. And I'm getting all these little memes. So just in time, folks, just in time. We're blessed that you're here. Yeah. Excited that you came and joined us again for another Ask Me Anything. Come back next week. Maybe we'll be here. Maybe we won't, but we will answer the questions that you bring. Try to come and stump us. See if you can bring something new, bring something fun, and bring a friend. So see you next time.
Take care, everybody.